Common Stocks and Uncommon Profits. Full sentence summary. Common Stocks and Uncommon Profits by is one of the most influential books ever written about long-term investing. Instead of focusing on stock prices or market timing, Fisher teaches investors how to identify outstanding companies that can grow for many years and reward patient shareholders. The book begins by explaining that buying a stock means buying a part of a real business. Therefore, investors should study the quality of the company rather than simply looking at its current share price. A great business with strong management, innovative products, and long-term growth potential is usually a better investment than a cheap company with poor prospects. One of Fisher's most famous ideas is the scuttlebutt method. He believes that investors should gather information from many different sources, including customers, suppliers, competitors, employees, and industry experts. By talking to people who know the business, investors can gain valuable insights that are not always available in financial reports. Fisher introduces 15 important characteristics that every great company should have. He says that successful companies should have products or services with strong demand, opportunities for future growth, effective research and development, efficient sales organizations, healthy profit margins, honest financial reporting, excellent employee relations, and highly capable management. Companies that consistently improve their business while treating employees and customers well are more likely to achieve long-term success. The book also emphasizes the importance of management quality. Fisher believes that exceptional leaders think about the future instead of focusing only on short-term profits. They invest in innovation, build strong teams, make wise business decisions, and maintain high ethical standards. Honest and competent management is one of the most valuable assets a company can possess. Another major lesson is that investors should hold outstanding companies for a long time. Fisher argues that frequent buying and selling often reduces returns because of taxes, transaction costs, and emotional decision-making. If a company continues to perform well, investors should allow time for the business to grow instead of selling too early. Fisher advises investors not to purchase stocks based only on low prices or attractive valuation ratios. A cheap stock is not necessarily a good investment if the company's future is weak. Paying a reasonable price for an exceptional business often produces better long-term results than buying an average business at a bargain price. The author also explains that investors should avoid making decisions based on rumors, market excitement, or fear. Successful investing requires careful research, patience, discipline, and independent thinking. Emotional reactions to market movements often lead to costly mistakes. The book teaches that diversification is useful, but owning too many stocks can make it difficult to understand each business properly. Fisher prefers holding a smaller number of carefully researched, high-quality companies instead of spreading investments across dozens of average businesses. Fisher concludes that investing success comes from identifying outstanding businesses with excellent management, strong competitive advantages, continuous innovation, and long-term growth potential. Investors who perform thorough research, remain patient, and think like business owners rather than traders are more likely to build lasting wealth over time. Overall, Common Stocks and Uncommon Profits teaches that the best investment strategy is not chasing quick profits but owning exceptional companies for many years. The book remains a timeless guide for investors who want to build wealth through knowledge, patience, and disciplined long-term investing.